What hopes do you have?
Yeah, so I really don't have any specific hopes in terms of what they can or can't do. What my process is really like is studying historic probabilities and letting that inform my investment view. So let me give you some statistics really quick. I think every investor has really heard the fact that 100% of the time, 12 months after a midterm election, stocks are up. There is some sort of bias to that statistic, meaning that if you look at it versus baseline odds, 70% of the time stocks go up. And if you pick your starting point in October, you pick up 15 percentage points of seasonality in that. So it's not really statistically different. So of all the data I scrubbed, there is something pretty interesting about midterm elections. The market does have a strong tendency, 70% of the time, multiples contract going into midterm elections, and 85% of the time actually expand coming out. So I think investors need to be aware that A, the market is a very effective discounting mechanism, and B, interestingly enough, if things that you're concerned about are an earnings deceleration, be aware that we might actually see a multiple tailwind over the next 12 months, which actually could be a pretty significant offset.
Really interesting, and we definitely saw that in October as well. So I want to get back to that in a second, but first, the dollar. What we've seen is that usually the dollar winds up rallying into the end of the year, regardless of midterms, because you're the funding squeeze. That story sort of sidelined yesterday when the dollar sold off on now we're not going to get a huge fiscal stimulus 2.0. Where do you guys stand at Bank of America? Yeah, we see downside risks to the dollar from here. We think that gridlock in Washington will persist. We're somewhat skeptical that anything is going to get done between the Republicans and the Democrats, at least in the very near term. And with that backdrop, we think that you're just going to see a slight deceleration of growth next year, moving closer to trend by the end of next year, and that's not going to bode well for the dollar or rates.
So no more tailwind from tax cuts, essentially. But what if trade got resolved, or at least moving toward resolution? What might that do? So if trade got resolved, that would work in the opposite direction. That would be a big surprise. I think the market would sense quite a relief from that type of development, and certainly that would probably allow for rates to sell off a little bit, risk to be bid, and probably for the dollar to strengthen a bit. So that is a clear risk right now, but based upon what we know as far as the political outcomes are concerned, we think that it's going to be gridlock for the next few years. And gridlock, if that means a weaker dollar, that's also a boon for stocks. Denise, I'm curious as to when you scrub the data, if it was a sector-specific story, because I keep looking at this particular chart over the last 2 years of the sectors and the outperformers after President Trump was elected, right? Consumer discretion, financials, and technology. When you look at the historical pattern for after midterms, what do you see on a sector basis?
Yeah, interesting. Just echoing those thoughts on the dollar, I will say that, 90% of the time after we've seen a move of this magnitude, because it's been pretty severe, 10% appreciation over the last 9 months, you do see deceleration in the dollar. So I think just from a historical risk-reward perspective, I think that that's exactly on point. Now, from a sector perspective, in terms of midterm multiple appreciation, there actually hasn't been a consistent pattern within individual sectors, but you do see one of the benefits of looking at sectors is you can really divide them into what I like to call asset classes, which are defensive sectors like consumer staples, utilities, healthcare, and telecom, formerly telecom, and then the rest of the sectors that are cyclical or economically sensitive sectors like energy, industrials, materials, consumer discretionary technology, financials, and real estate actually falls into this, as does comm services. That cyclical sector, usually the asset class, sort of benefits from the tailwind you see from multiple appreciation, but it hasn't been a consistent signal in terms of this sector works more often than not.
So, Mark, put that analysis of cyclicality together with global growth. Where are we with global growth? Because that could cut the other way if it's softening.
Yeah, that's right. And we do think that just with the U.S. Slowing over the course of next year as the benefits of existing fiscal stimulus fade, that's going to be a challenge for the global growth cycle. The Europeans are obviously in a very challenging place. We're not seeing concrete growth out of Japan, and we don't expect that anytime soon. So it's really been the U.S. that's been leading the charge. And if the U.S. begins to slow, then that doesn't bode well for the rest of the world. And then wrapping it up here, Denise, when you talk about the cyclicality, I just want to hit on tech because a weaker dollar, obviously good for tech, global slowdown, bad for tech. Tech just got totally hammered. Hedge fund tech specialties got really hammered in October. Where do we go from here?
Yeah, from a risk-reward perspective, I actually think it's still favorable for technology. What's interesting, as much as you say it's gotten hammered, on a relative basis, we're dead in the middle of the histogram in terms of relative underperformance on a 1 or 2 month basis. So we really haven't seen any statistically significant underperformance, which sort of raises its hand as a signal. The fundamental drivers of margin acceleration still look positive, both within internet and even excluding internet that's now moved to the communication services sector. What I will say is that valuation, actually, without internet services, has now dropped to the bottom quartile of its historical average on a relative basis, which that in and of itself, regardless of fundamentals, has offered you above 65% odds historically. So the risk reward from a valuation perspective still looks beneficial. That said, the market got very, very narrow from a sector perspective, only 3 sectors outperforming in the prior 12 months. That only happens 5% of the time, which is pretty rare. But what you usually see is it broadening back out very quickly to 5 or 6 sectors. So I think tech might be challenged in terms of its dominance of outperformance, but I think the risk rewards there are still positive.